and potential situations where current liabilities are created and we get rid of them. We have a couple other issues we'll deal with current liabilities in general, and then we're going to get to our second big category, which is contingencies. So a closer look at the current and non-current classification. Current maturities of long-term obligations are usually reclassified and reported as current liabilities if they are payable within the upcoming year. So for example, if you have a long-term note that's for 40 years, for 39 years it's going to be down in your long-term liabilities, and the year before it becomes due, it should move up into your current liabilities the year before that. We're going to see here in a second there are exceptions to that rule, but in general that is what would happen. The current portion of long-term liabilities gets moved from the long-term up to the current section on the balance sheet. Debt that is callable, in other words due on demand by the lender in the coming year, should be classified as current liabilities even if the debt is not expected to be called. So if you have debt that the person that is lending you the money can at any time say, hey, I want the money back, then it's always going to be a current liability. Even if you don't expect to have to pay in the next year, it's still going to be a current liability because there's the possibility you will have to pay if they ask for it. So that's why firms almost never use callable debt, because it would always be considered a current liability the entire time they hold it. So this is the exception to this bullet point up here. Short-term obligations expected to be refinanced. A company may reclassify a short-term liability as long-term if two conditions are met. Number one, it has the intent to refinance on a long-term basis. And number two, it can demonstrate the ability to refinance long-term. So for example, let's say we have a liability for 40 years. In the year before that thing becomes due, if you can show that you plan to and have the ability to refinance that thing again long-term, you never have to move it up to the current liabilities. You can leave it down in the long-term liabilities. So how do we show that we have the ability to refinance? There's only two ways we can show that we have the ability to refinance, and that is either to have an existing refinancing agreement in place. In other words, you've gone to either the same financial institution or another financial institution and say, will you lend us this money when this thing becomes due? You have a written contract that says that they will, and you show that to your auditor and they say, great, you can go ahead and keep that in the long-term liabilities. Or the second option, which is probably more common, they do the actual refinancing prior to the issuance of the financial statements. So the financial statements, let's say, are issued in March, and December 31st is your fiscal year end. If you actually refinance in that interim period, that is good enough to show that you had the ability to as of December 31st, and you can leave it down in the long-term liabilities. So those are the two ways you can show that you have the ability. So to have an existing refinancing agreement, or to actually refinance prior to the issuance of the financial statements during that interim period. One difference, so this is everything we just said right here is true under IFRS as well, except this second thing. The actual financing prior to issuance date is not acceptable under IFRS. Under IFRS, refinancing must be completed before the balance sheet date, so they have to have an existing refinancing agreement in place. They can't say in January do the refinancing and count that. So there's one difference there between US GAAP and IFRS. All right, any questions about that classification or when we get to keep it down to long-term liabilities? Is that pretty clear?
So you wouldn't ever reclassify it into short-term if you were if these other conditions were met?
Yeah, you want them to be long-term, right? Because it looks less risky. So almost all firms, if they're planning to refinance long-term, they're going to use this and keep it down in the long-term liabilities. Unless they're planning to pay it back and not refinance, then they would go ahead and move into the current, and then it would go away, because then they would pay it back. All right, so that's the end of part A. Part B, contingencies. So a contingency, a loss contingency is an existing, has to be existing, uncertain situation involving potential loss depending on whether some future event occurs. So the easiest example of this is a lawsuit. Someone sues us, and depending on what happens, if the jury finds for us or for the other party, or if the judge dismisses it, or if we have to settle, depending on what happens in the future, either we're going to pay something out or we're not going to pay something out in the future. There's lots of other potential contingencies, but the lawsuit is an easy one to think about. It's uncertain if we're going to pay this thing out, because it has not yet been resolved. So it has to be existing as of the end of the period, and there has to be potential for loss. In some cases, we're going to record a liability, even though we don't know for sure if we're going to have to pay something out. In other situations, we don't. And so we need to determine when do we need to record the liability, and when do we not record a liability. Two factors affect whether loss contingency must be accrued and reported as a liability, and they are the likelihood that the confirming event will occur. So think the likelihood that the jury will find against us, or will find for us, and whether the loss amount can be reasonably estimated. So can we estimate the amount we're going to have to pay, and what is the probability that we're going to have to pay this amount? Note that the cause of the uncertainty must occur prior or during the period for the loss contingency to be considered. In other words, it has to happen, whatever it is that we did bad has to happen before December 31st. It doesn't have to be resolved if we're going to pay and how much until after December 31st, but whatever it is that caused it has to have happened prior to December 31st. So, for example, we were negligent, we killed someone, and we're going to have to maybe potentially pay something out for a wrongful death suit or something like that. We had to have killed them prior to December 31st. If we killed them on January 2nd, it's not going to go onto this balance sheet. If we killed them on December 15th, then it's very morbid. I don't know. Okay, we hurt them in some way. We did not kill them. It's still bad because we hurt them. We did something that was not good. And we either did it in December, or during this period, or we did it after the period ended. If it's after the period ends, it's definitely not going to be the balance sheet. All right. This little table is going to tell us what we're going to do with it. And so first we're going to talk about the likelihood of occurrence. So we have three potential likelihoods. Every event has to fall within one of these three baskets. They are either probable, reasonably possible, or remote. Everything falls within one of those three. Probable, a confirming event is likely to occur. Reasonably possible, the chance the confirming event will occur is more than remote, but less than unlikely. And remote, the chance the confirming event will occur is slight. Those are the words that the standard give us to tell us what it means. As a class, we're going to put numbers to this. The standard doesn't say it has to be this percent likely, but we're going to say as a class what we think these words mean. And obviously none of us are going to agree exactly, but we're going to kind of, as a class, come up with numbers we're going to use moving forward. So basically on a probability line of 0% to 100% likely, where do you think probable falls on this number line?
Below what?
Okay, so definitely 100%. And so the question is how far down? So you think 90 to 100% is probable. Okay, any other numbers you want to throw out?
95.
Okay, 50 to 100, that's a possibility. 70. Okay, so what do we think as a class? What number do we want to use?
75.
The event is likely to occur. So you can think about it any way you want. You can think about it with weather, the likelihood that it's going to rain. You can think about the likelihood you're going to get this promotion. However you want to think about it in your brain to think about these words, you can do that. So what are we thinking?
51.
You like 51?
60.
60?
61.
61. Stop, please. So do we want to use 60? Do we like 60?
Yeah, 60.
I mean, so I heard 90, so you want to do 99? No? Anyone wants to do that? So it'll be like 60 as a class? All right, we'll use 60 then. So minus 50, we'll say 60. This is not to scale. From 60% to 100%, we're going to call that probable. So if the probability of something happening, or the likelihood of something happening, is 70% in our example, we would call that probable. If it's 99, that's also probable. Where would we consider remote? Where's remote on this?
10%.
30% to 0?
20
20 to 0?
0 to 10.
0 to 10.
0 to 10? Any statistics fans, you're going to say 5% is a p-value, right? No?
Yes.
You do double sided and it's 10%? No? So what do we think? So I've heard 10, 30.
10.
Anyone else want to? 5? Doesn't have to be the answer, just doesn't stick around.
Okay, 1.
1? Whoa, that would definitely be remote. Okay, we need some kind of consensus.
0 to 10.
10.
All right, we'll go 10. I heard 2 people say 10. That's the whole class, right? All right. So 0 to 10% we're going to call remote, and that means everything else is reasonably possible. All right. There's no set numbers here. This is just what we think. This is using our judgment, and different reasonable people could come up with different numbers that they think is appropriate for the words. All the standard gives us is the words, and you figure out what you think that means. So now we're going to see what happens for each of the 3 categories. If something is remote, we do not have to disclose it at any time. Tell no one, it never happened. Okay? We killed someone, just don't tell anybody. Because the probability of paying anything out, it's not our fault, it's someone else's fault. We're not going to pay it out, so it's remote. Don't tell anybody. Don't put it in the notes. Just ignore it. Sorry. All right. If it's reasonably possible that we're going to pay out, so in our case 10 to 60%, then we have to disclose it in our notes, but we do not have to create a liability. So in the notes somewhere, there's usually a section associated with contingencies that's going to say, we've been sued because we killed this person, and we may have to pay something out. We think the probability is reasonably possible we're going to have to pay something out, period, and that's it. That's all I got to do. If it's probable, in our case 60 to 100% likely, if we know the amount or we can estimate it, then we create a liability that goes on our balance sheet. So only when something is probable and we can estimate the amount does it go on our balance sheet as a liability. If we cannot estimate it, then all we have to do is disclose it. So if we have no way of estimating how much we're going to have to pay out, then we wouldn't be able to come up with a number that's reasonable, so we would just disclose it. We don't actually create the liability. So when we can estimate it, and it's probably going to pay out, it's a liability on our balance sheet. An example of a liability that we have already seen as a contingent liability is a warranty liability. A warranty liability is basically saying it's probable we're going to have to pay something out. We don't know if the transmission is going to fall out of this car or not, but it's probable that we're going to have to pay out some on average to people that bought our cars. And so we're going to create a liability called a warranty liability and accrue that and record the expense in the period that the car is sold. And so because it's probable and we can estimate how much, we create a liability. That's where warranty liabilities come. It's because they are probable and we estimate the amount. Any questions about when we record contingent liabilities? A loss contingency is accrued only for losses probable and not be reasonably estimated. Under IFRS, a contingent liability only has to be more likely than not. Basically, they use very similar words, probable, reasonably possible, and remote, but they define probable as more likely than not. What effect would that have on our numbers here? Probable means more likely than not. More than likely than not has to be 50%, right? Or 51%. So the only difference with this probable number would have to move down to 50%. If it's 51% likely under IFRS, you have to create a liability. So essentially the effect is, and obviously this is relatively low, most classes pick 80 or 70%, some have picked 90 in the past. There's going to be a grouping of contingent liabilities between 50% and 60% in our case, that under US GAAP, we would not create a liability. Under IFRS, you would create a liability because of that one difference. Other than that, the treatment is pretty much the same under IFRS. I guess the one other difference is they use a different word. Instead of called a contingency, they call it provisions. But other than that, it's treated exactly the same.
What's the difference between the no and the reasonability estimate for the probable?
So if you know exactly how much you're going to pay out, that's known. And if you don't know, but you can estimate it, that's that you can reasonably estimate. For most of these things, you don't know exactly how much it's going to be, but you can estimate it in most cases. All right, product warranties and guarantees. Product warranties inevitably entail costs. The amount of these costs can be reasonably estimated using commonly available estimation techniques. And as I just mentioned, okay, there you go. That's what we do. All right, don't need to talk about that anymore. One other example, actually, I guess there are two other examples. The next example, example number 7, is a contingent liability known as a premium. This is not the same thing as the discounted premium we do with bonds. This is a different type of premium. This premium are basically, and I'll just read this, premiums included with the product are expense in the period of sale. Premiums that are contingent on action by the customer require accounting similar to warranties. Not a description. Basically, a premium is anything that someone gets along with something that they bought. Let me think of a good example. So for example, stores don't do this as often as they used to, but it used to be you went to like CompUSA. Do those even exist anymore? Okay. You go to a computer store and you buy a printer and they give you a cash rebate that you have to mail in. But you get the computer, you take this thing, you attach the receipt, you mail it in, and you get $15 back as a check in the mail. What other examples? Maybe phones sometimes do this now.
Tires do it.
Tires do cash rebates. There's also, doesn't have to be a cash rebate. Sometimes you mail it in and you get some item, sometimes happens. So these are examples of premiums. It's something you get, but the customer has to do an action before they get it. Why would, for example, a computer store want to do a cash rebate? Why don't they just take the money off from the amount that they're selling it for? Because they know that the majority of people are never going to turn that thing in. That's what they know that, right?
Mm-hmm.
They also get a month to pay it out. So
that as well. So there's also that period of time that they can basically they keep your money for that period of time. That's another good point. So for a variety of reasons they do this. For me, they know that they're never getting it. I'm never going to get that money because I'm just not going to turn it in. That's what happened. So I just ignore those things because I know I'm never going to turn them in.
sometimes they don't send it back. Like you send it the rebate and they never get back to you.
So I think I remember doing a rebate, and this was a lot of years ago, back when I was a student. I think I turned one in and I got it back like a year later. I finally got the money.
Now they have the tracking rebate, so you can track.
Oh yeah, online. Sure.
But it takes long, like 2 months.
Yeah.
Really long.
So my preference is just to avoid these things. But they do exist, and we need to figure out how they are accounted for. Yeah?
Is that one, is buy one, get one free, a premium?
No, because there has to be some action the customer has to take to get the thing after the fact, after the sale. So it has to be a coupon they have to turn in, or something they have to mail in, or something they have to go online to do, or they have to come back later to get some action that they have to take after the fact.
Why do they pick the term premiums? Because it's kind of confusing.
I don't know.
Do they do
I'm copying the textbook in this word. To be honest, many companies call these other things, including promotional items, or that's the one I can think of, but the textbook uses premium, so I'm being consistent with the textbook.
I was gonna say that the international system use the same term, because they seem easier for everything, like versus GAAP.
No. In certain cases. We'll go with certain cases. Not always. I happen to teach, excuse me, forbid that. I happen to teach an IFRS class, and so there are certain things that they're easier, but there's certain things that are actually harder. So it really depends. I'm trying to throw my pen anymore. All right, so premiums included with the product are expense in the period of the sale. So it's part of the cost of selling the good, whatever that cost of that premium is. You don't have to do it for the full amount, just the amount you expect to actually be redeemed. Premiums that are contingent on action by the customer require accounting similar to warranties. All right, so here's our example. And I got this example from I don't know where, it's weird, but I've stuck with it for many years, so I'm gonna continue to stick with it. During 2009, Top Grain Leather Goods sold 1.8 million reversible belts. I do not know why they need to be reversible. That's what the problem had, so I'm stuck with it. The reversible belts, maybe like 2 different sizes, different colors, I don't know. Under a new sales promotional program, each belt carried 1 coupon, so this is a specific type of coupon, which entitles the customer to a $5 cash rebate. Deluxe estimates that 60% of the coupons will be redeemed, even though only 850,000 had been redeemed during 2009. Record the necessary journal entries and the amount that's going to be on the balance sheet. Alright, so the first thing is that the cost of this, in this case it's a cash rebate, but it could also be a good that we're giving them. In this case, the cash rebate, the value of this, we need to record as a promotional expense or some kind of expense. And again, this is the wording of the textbook. They call this a promotional expense and they call the liability a premium. If you interchange those, I don't care. They're both P words and about the same length. So I don't really, honestly, if you want to call these promotional expense and promotional liability, that's fine, or premium expense and premium liability, I don't care. But I'm going to follow the example of the textbook in my wording, and as long as I understand what you mean, you're fine. As long as I know which one's the expense and which one's the liability, that's what's really important. Alright, so in this case, we sell 1.8 million of them, that's a lot of reversible belts. And, but we only think 60% of these cash rebates are going to be redeemed. So only 60%, and then $5 each. This is the amount we think we're going to pay out to when these things get redeemed. And so we think we're going to pay out $5.4 million for all of these things that get redeemed. And so when we sell them, we're going to record a promotional expense of the amount we think we're going to have to pay out. Again, this is an estimate. And it's going to be wrong, because estimates are always wrong. And we're going to record a premium liability for $5.4 million. And we're going to keep track of this amount with a T account. And so we just put $5.4 million into this T account as a liability. And then through the end of 2009, 850,000 are redeemed. And I'll do the math down here. 850,000 times $5, which is going to give us 4.25 million. And so when they get redeemed, obviously we're going to pay out cash. This is going to be 4.25 million of cash. And we're going to get rid of the liability, premium liability of 4.25 million. So when we get to the end of the period, we're going to continue to have 1.15 million on our balance sheet as a liability. And then the next period, some more are going to be redeemed, and probably most of these things will have an expiration date. You can have expiration dates for cash rebates. And so when it expires, then we would record the remainder just as a gain or a loss, depending on if more got redeemed or less got redeemed than what we originally estimated. We won't go all the way through that, but that's what will happen. So the amount that would be on the balance sheet would be the 1.15 million. And then these would be the 2 entries for the initial recording of the expense, and the expense is going to be matched in the period that they're sold because of the matching principle. We want the revenue and the expenses matched, and that's what does it. Any questions about premiums or this problem? So I know in the textbook, one of the homework problems that I assigned has an example where it's not a cash rebate. And so you might want to look at that, because I know that's what I do on the exams, not a cash rebate. It's a good that's being given up. So you might want to make sure you understand how to do that from the homework problem. Alright, so that's premiums. For some reason I think I should do something else for this, but... Oh, I remember what I was going to say. So this is a contingent liability. Why are we recording the liability? What's the reasoning here?
unearned, is that?
Because it's not unearned, there's no unearned part of this here.
It's not.
Probable and reasonable.
It is probable and we can estimate the amount. It's a contingent liabilities that we are going to accrue as a liability, because it's probable we're gonna have to pay it out, and we can estimate the amount, boom, liability. That's the reasoning.
Are they for, because I don't know what it's for, if they don't even think everybody gonna return it. Are they to increase sales or something?
Yeah, that's right. Right, so premiums or these promotional items are always to try to make sales larger. That's the reason you do this. It's a cost of your sales is essentially what it is. Yeah.
In the textbook, do they give percentages for the probable, reasonable?
They do not.
So how do we? We made it up.
I don't know. I honestly don't remember what the problems look like in the textbook for that. They probably tell you in words that it's probable that something's gonna happen, is my guess, but I honestly don't remember. Incidentally, when we get to the exam, remember the numbers we use, because that's what you're gonna use on the exam. So 60%, 10%, that's what you're gonna use on the exam.